Michael Cochran here with BentOak Capital to provide our September 2023 market update. Please remember to stay tuned at the end of this video for a required disclosure statement. Financial markets lived up to their reputation during the month of August, which has had a record for being difficult. Early in the month, markets had to contend with a downgrade of U.S. long-term debt by the rating agency Fitch. They attributed the adjustment to the expected physical deterioration, a high and growing general debt burden, and the erosion of governance. Many financial leaders characterized the downgrade as ridiculous, but the stock and bond markets still felt the effects. Another setback for markets came from the credit rating agency Moody's. They issued a credit downgrade for 10 small to medium-sized banks and 11 larger banks, with a warning of increasing financial risks in the form of higher interest rates, escalating funding costs, and the rising risks from banks' commercial real estate holdings. Still, despite the credit-related downgrades, markets were able to navigate their way through the ongoing debate of the country's financial strength. Better than expected earnings reports, coupled with an optimistic outlook, helped underscore the overall durability of corporate America. That durability showed up in a couple of ways. First, the unemployment rate in the U.S. was at a multi-decade low of 3.5%, so consumer spending has remained resilient. Back-to-school shopping was strong, which has been a positive signal for future holiday sales. Second, the housing market defied higher mortgage rates as the low inventory of houses on the market supported elevated prices. The National Association of Realtors chief economist noted that with a strong labor market, the pool of prospective buyers has been enlarged, but with rising mortgage rates and limited inventory, the possibility of home purchases may be hindered for many. Resilience aside, the market still experienced some volatility, with the pullback in the stock market and high bond yields, specifically the 10-year Treasury. Reports of consumer confidence and the number of available job openings also came in softer than expected, which helped alter expectations that the Fed would raise rates again this year. Although the debate over the need for another rate hike continues as the Fed monitors incoming data, the meeting in November will need to address a number of issues. So where does that leave the market through year-end, especially since September historically tends to be another difficult month? Since 1950, a strong market performance in the first 7 months of the year has been followed by mid-single-digit returns until year-end. Given the S&P 500 enjoyed a great start to the year, we may be positioned for a positive end to 2023, although potentially with some bumps along the way. That wraps up this month's video, but please visit the Resources tab on our website for several new blogs and be on the lookout for periodic updates through our social media channels. We continue our commitment to providing personalized service, and if you have any questions, please feel free to reach out to us.